Hey everybody, it's Seth and Uncle Paul for the Everything Money channel. Welcome in. We welcome you into our channel, all of our subscribers, all of our OG followers, and our patrons all around the world. Thanks for joining us again to analyze Lockheed Martin. Obviously, this is American aerospace, defense, security. They do a lot of stuff. They make scary bombs, and a lot of people are interested in their stock price. This is from our Patreon request line. Hunter, thanks for letting us know you're interested in this. Other people have mentioned it, Paul, but I welcome you in, my dear friend, and your off pink shirt, your salmon, whatever. What do you want to call that shirt?
Purplish.
It's a beautiful shirt. You look like Tinky Winky.
Lilac.
Yeah, and it's just gorgeous. You do look good in feminine colored shirts.
Well, you should see me in women's clothing.
So welcome to the show, everybody. And
Don.
Paul, tell us about Lockheed Martin.
Well, can I make a comment real quick? Because this is the most common thing we get. You out there are going to comment below, can you look at the X company? We have the Patreon for that reason. We've gotten so inundated. We're very fortunate to have over 10,000 subscribers now. If you want to make requests, join our Patreon, patreon.com/everythingmoney. The great news about that is you will get the 8 Pillars website and app when it's complete, and you'll get to join our Discord channel. The sooner you join, and we're giving away 2 Teslas this year for only paying Patreon members. So join, you can make your requests. We will actually look at them, and we will do them at some point. So, Lockheed Martin.
Lockheed Martin.
Okay, guys. So, Lockheed Martin, to start, is a $95 billion company. This is the market cap. I don't ever look at price of the company. I look at market cap, which is number of shares outstanding times the stock price.
Price of the stock, you mean, Paul?
What did I say?
You said company, but regardless, you don't
Price
really
of the
look at the stock
correct.
price. Yep. So
Correct.
This is
the price of the company, is the market cap.
Pillar number 1 is PE ratio. We want this less than 20, folks.
14.6, check mark there.
Come on, I like that. Okay. PE is good. How about profit margin? We want this above 10%, Paul.
It is 10.29.
Okay,
Now,
2.
they're paying a 3% dividend. This is
like
important because it's about $3 billion a year they're spending on dividends. What we want to do is, when we look at the free cash flow, that is what free cash flow, we want to make sure this dividend is supported. So many of you see a dividend and think, oh, it's safe. You want to make sure the company can actually safely pay the dividend. So I calculate the actual dividend. It's about $3 billion a year, so you have to factor that in.
We will look at free cash flow in pillar number 7. What were you going to say, Paul?
But so far, we have 2 check marks.
Pillar number 3 is revenue growth over the past 5 years. Obviously, we want our great companies to be growing, Paul.
We would like that. So, 40 billion to 60 billion, check mark. That's pretty big growth.
Great.
Yep.
Profit growth. We want the profit growth to be growing, Paul.
Profit growth, net income, 3.6 to 6.23. Another chickadee check there, guys.
Chickadee check yourself before you. Shares outstanding is pillar number 5, Paul. We want this going down, not up. We don't want them selling off more shares.
310 million down to 282, another check mark.
Okay.
Almost a 10% reduction in shares over the last 5 years, which is incredible, which means if there were 10 shares outstanding before you owned one, now there are 9 shares outstanding and you still own your 1. So your ownership went from 10%, 1 out of 10, to 1 out of 9, which is 11%. So you actually get more percent of the revenue and profit and cash flow of the company now when they buy their shares back.
This is 5 straight checks for Lockheed Martin.
5 straight?
Pillar number 6 is current assets greater than current liabilities.
I
Paul.
bet you this is going to be our first X. What do you think?
I don't know what these military companies, I don't know what they...
I feel like there's a lot of money outstanding on things, but we'll see.
Okay.
Total current assets, $20 billion. Total current I was wrong, $15 billion, check mark there.
Unbelievable.
They have plenty of cash on hand. Total current assets to pay all their current liabilities of $15 billion. That's current liabilities are the bills they basically have that are due very quickly.
Now, Paul, I can feel the heat from your undercarriage because we have 6 straight checks.
What's free cash flow?
Pillar number 7. You're going to ask me this? Free cash flow is it's cash from operations minus capital expenditures.
Great,
Paul,
and what do we
whatever
use
that
it
means.
for?
Well, that's a good question. I'm losing my mind.
You use it to the company uses it to pay dividends.
Which they have a 3% dividend. Lockheed
$3 billion.
Martin does, so, okay.
They use it to buy back shares, which they're doing. They use it to make major acquisitions, reinvest back in the business. It's commonly used more by value investors to look at value versus PE. So right now, and the other thing I want to look at is I want to make sure their capital expenditures are too big of a chunk of their operating cash flow, which right here it's about 20%, which is a good ratio.
All right, free cash flow over the past 5 years. Let's do it, baby.
4.2 billion 5 years ago, 5.9 billion in 2019.
Wow, that's good.
Check
Okay,
mark.
so it's going up. And what are the 3 to get the average of the past 5 years? I see them there, Paul.
4.1, 5.3,
5.3,
1.9.
1.9.
For an average?
The average free cash flow over the past 5 years is 4.3, Paul.
Okay, 4.3 billion. So the next question we received the most of is,
what do we do now?
What do we do now? I always talked about multiplying this by some sort of factor, like a PE kind of factor.
Usually it's 20.
Usually it's 20. Now people will say to me, why'd you pick 20? So I'm working on a calculation to tell you, based on growth rates, how much you should multiply this factor by. Lockheed Martin's a very large company. I look at size and growth potential. The bigger the company, the less the growth potential here. Okay? This company is growing fast. It increased its revenue by 50% over the last 5 years, but the free cash flow didn't jump up by the same amount. Pretty close, but not by the same amount. But it is a very established government contractor. I would sit there and say, I'm still going to do 15 times free cash flow because I don't think this is a sexy company that's going to. It very much relies on the government and what they view the military with, Biden coming into office. I think you want to be more conservative.
So what Paul's doing here, folks, for normal people like myself, I'll explain it. Once we get that free cash flow average, which is 4.3 billion, we're going to multiply it by some number to get what market cap of the company we think it's worth, and then we're going to compare it to what
the current market cap
the world thinks it's worth, with the current market cap. So, Paul,
I picked 15. So 4.3 times 15 is 65 billion.
That's what you think this company's worth,
now,
right?
keep in mind, though, Seth.
Go on.
Last year, they did almost $6 billion in free cash flow.
Okay.
So some people might be willing to pay more. I'm sitting there saying this is probably a 65 to 75 billion dollar company.
And the current real market cap is 95 billion.
95 billion. So we need this company to drop by about 30 or 40%. It's currently at $338. So I'm looking at this company sub 230. Anything below 230, I'm gonna do more detailed analysis on it. I'm looking at saying that's $230 a share.
So when COVID hit bad, it was at 290, 291. In 2019, it was at 256 down there near December. And in 2017, it got down to 230 something. Well, October of 20.
Correct. It went from 2013, it was $88 and just went on a rip.
Yes.
I still think it's overpriced, even though the 14 PE, it says it's not overpriced. So this is part of the balance of investing. It's looking at all these things. You have to understand, why is the PE and why is the free cash flow and net income so different? Over long periods of time, net income and free cash flow should be very similar to each other. But if you look in the last, well, actually, let's look at the last year. Because 2020 is done. Let's look at the trailing 12 months and see how they did free cash flow wise.
Will you wipe that board?
Absolutely. Nothing would make me happier.
Nothing. We appreciate you guys. Make sure you're tickling that thumbs up. And yeah, we love you. Thanks for watching. Go ahead, Paul.
They did $6.2 billion in free cash flow in the last 1 year.
This year, 2020.
Yeah. So it's something, well, not including last quarter, through September 2020.
Mm-hmm.
So that's a big, I mean, it's applying the same 15. It's at 93 billion. So maybe it's okay. But remember, guys, you have to assume that this 6.2 is safe and it's going to continue.
Yeah.
So this is part of looking at investing. It's not just this, oh, I'm going to do this right now. It's about understanding, like, do I think that this $6 billion free cash flow is sustainable for a long period of time and growing? If the answer is yes, this might be a good deal right now. In fact, I might look at some options right now. Do you mind if I look at some options, Seth?
Go ahead.
We can explain what we're doing with the options?
I would say I think there's interest in this company, Paul, because in February, at the height of the market, it was $440, and now it's down to $338. And so I guess maybe people see this massive drop as thinking an obvious time to buy in.
Maybe so, but again, we go based on value, not price.
Right.
So what we do with options, guys, is I like I like selling options. What that is I sell people puts. What that's doing is I'm giving them the right to force me to buy the shares at a price I want in the future. So let me try to make this bigger. Okay, what's Lockheed Martin's ticker symbol?
LMT.
So I'm going to pick a date in the future for puts. So remember, a put is I'm selling somebody the right at a lower price to force me to buy the shares. So for example, the stock's currently at $330 a share. I might sit there and say, hey, at $250 a share on X date, I'm forced to buy it and they'll pay me $1 for that or something, some arbitrary number. If it goes below $250, I'm forced to buy it for $250. If it's above 250, I keep the dollar. I keep the dollar either way. But if it's above 250, I'm not. Nothing happens. I keep my dollar. I write another contract.
What's the strategy behind this? You want it. You think it's worth that. So if it goes to that,
I will gladly buy it at that price.
Because
I would have bought it at 250 anyhow. It could go to 230, but I'm buying it for 250. But somebody would say, "Oh, you lost money." I look at it saying, "Well, I was going to buy it at 250 anyhow, so I would have lost $20 a share no matter what." It's just allowing me to get some income along the way while I wait.
So you're just really making money while you wait and getting a stock at the price you've targeted anyway.
Correct. So let's go to June 18th, 2021. And let's go further because this is a big company. Let's go a year out from today. Not from today, but from very close to today. And I want to buy it I want to sell $200 contracts. So what I'm doing here is $200 strike price. That means on January 21st, 2022, somebody can force me to buy the shares at $200 if it's selling for below $200 a share. And somebody's going to pay me about $3 to do that. So I'm going to make about 1.5% of my money, which is not very much.
$3 per share?
Somebody will pay me $3. So if I sell one contract, which is 100 shares, so they're going to pay me $300. Now what that means though is if it ends up below $200 a share, and it's currently at $340 a share, so if it falls that big number and more, I'm forced to buy it at this $200 price. So let's say it goes to 150. If it goes to 150, I just lost $50 a share, less the $3 they gave me. Because I'm forced to buy it at 200, even though the market's at 150.
So if something drastic happens where like this whole thing goes south and the market opens it down to it just skips 200 altogether.
Yep.
And goes from where it's at, maybe it's somehow down to 150. You're still forced to pay 200 for it?
On that strike date. Yep,
okay,
correct.
Yeah.
So
wow.
it's a very high risk proposition, but at $200 a share, a lot of you guys are probably thinking, it's not going to $200 a share. I don't know. The whole point is on value investing, if I think it's worth $200 a share all day, fine. If it goes to 150, I would have lost $50 a share anyhow when I bought it at 200. The big risk is between now and January of 2022, something changes in the company that makes me go, oh shoot, it's not worth $200 a share anymore. It's worth $125 a share to me. And that's the risk you take with options. And that's how I use options to generate income and buy stocks at prices companies that I want at prices that I want while I wait.
So if you've made it this far in the video, we really appreciate it. We're looking at Lockheed Martin that gave us all checks all the way down the board. And still, Paul, you still think this stock price needs to drop a bit before you're a buyer, but we still like the company.
Even though the PE is low, I still want to look at why is the free cash flow and the PE so different.
If this resonates with you, this mathematical analysis of companies, feel free to join our Patreon, patreon.com/everythingmoney. The link is in the description below. We are giving away 2 Teslas this year to our patron members. And so feel free.
I want to make a correction.
Go ahead, Paul.
The free cash flow was $6.2 billion in the last 12 months. The profit was 6.5. So it's actually pretty close. So that's the reason why that was confusing for me. And the trailing 12 months, I look at trailing 12 months now, so it's actually pretty close to each other. The question you need to ask yourself is this sustainable for Lockheed Martin going forward? Do I think Lockheed Martin will be a company in 5 years that's around? Absolutely. Do I know that they're going to make $6 billion? Do I think they're going to make $6 billion a year for the next 5 years at least in free cash? I have no idea. And that's part of the due diligence that you need to do and dig deeper on.
What is consistent is the heat that you'll feel from Paul's grundle on the Patreon page when you have access to him in our top tier. Love you, Paul. Love our followers. Thanks for watching, and stay tuned, guys. We'll be doing this all year. Way more videos, Paul. We've been doing this for over 2 years now.
100,000 subscribers, baby.
And 100,000 subscribers is our goal this year. So thanks for joining along. We love you guys. See you.